So the financial ratios refers to the analysis of various pieces of financial information in the financial statement of a business. So we isolate certain accounts from the trial balance, from the income statement, from the balance sheet. We isolate them because they're the only ones. They're the only information that we need to generate the specific ratios that we are looking for. So the ratios that we are the most common ratios we are looking for is the liquidity ratios, whether or not we can pay the debts, the activity ratios, the relationship between our working capital, the current assets, current liabilities, and our sales. And the last one is the profitability ratios, where we identify the percentages left for all the other expenses and the return on investment. So remember that in ratio analysis, some of them do not do well just standing alone. Hindi pwede na we only have a singular data for the ratio analysis. The basis for the main purpose of the ratio analysis is just to standardize the way investors, so external people from the business, possible investors, possible shareholders, stockholders, all of those. The ratio analysis gives them a standardized way of looking at the financial statements, at the important aspect of the financial statement, so that they can compare the data from business to business by just looking at the ratios, because that's what they need to know, because assuming all of the companies within the same respective industries have different values in their balance sheet. So ratio analysis somehow standardizes that the difference between all of those businesses within the industry that they could potentially invest in. So let's start with the liquidity ratios. Under liquidity ratio, we have the current ratio and the quick ratio. So for the current ratio, this is the ability to pay off obligations using all of our current assets. Could you give me the example of the current asset accounts that we have?
Accounts receivable po.
Okay, accounts receivable,
Cash.
cash, yes.
Supplies.
Supplies, yes.
Buildings po.
Building is a fixed asset. It's not a current asset.
Ay, isa pala.
Inventory.
Furniture po.
Inventory, sir.
Inventory, that's correct. Furniture is also a fixed asset.
Prepaid expense.
Okay, prepaid expenses. So we have cash, accounts receivable, all of our prepaid expenses. So that's inventory. So our current liabilities are the liabilities that we would pay off within a year. So hindi kasama sa current liabilities ang loans payable natin, because loans payable are long-term commitment, long-term liabilities incurred because of the debt financing option that we use when we are establishing the capital structure of the business. So let's try solving. So first, we identify the current assets and current liabilities. In this balance sheet, can you identify which are our current assets?
Cash, account
Okay, cash.
receivable, prepaid expense.
Okay, so we have cash, account receivable, and prepaid expenses. How about our current liabilities?
Accounts
Accounts
payable.
payable, income tax payable.
Okay, we have accounts payable and income tax payable. The second step is we need to total our current assets. So 212,000 plus 60,000 plus 71,000 is equal to 343,000. After that, we total the current liabilities. 14,844 plus 75 is equal to 14,919. Fourth step is we do the ratio, the current ratio. We compute for the current ratio by dividing the total current assets with the total current liabilities.
22
So,
point,
do you have the value?
22.99 po pa, sir.
It's 23.
Ay,
Okay, 23. We have, the value is actually 22.99. So what does the current ratio mean, this 22.99? for the business. That means that with the current assets that we have, we could pay our current liabilities 22.99 times before we deplete our current assets. So we interpret that as 2 if it's a good current ratio. Less than 2, that means we cannot pay debts because the current assets is composed of the inventories and accounts receivable. So those are cash values that are not yet ours or hasn't been converted into sales yet. If it's more than 4, they said it was an asset management, although I think this is a judgment call depending on the business. If they wanted more liquidity, as long as they're not going bankrupt, I think more than 4 is an okay current ratio. So in that case, we have 22.99. We have uh, very huge amount of liquidity to pay for our debts. So try solving for this current assets. For this balance sheet, we need the current assets. Remember to identify first the current accounts, current assets, and current liabilities, total them, and then divide. Our current assets total to 475,000, and our current liabilities is 150,000. So current ratio is 3.17. So this is a good current ratio. Okay, so let's proceed to the second one under liquidity ratio, which is the quick ratio. So the quick ratio it's the same principle. It's the ability to pay off obligations, but we're only using our quick assets or our liquid assets. The liquid assets being the cash and the accounts receivable. Also, but we don't have any of it. Pag sabi nating quick or liquid assets, these are assets that are already in cash value. So pwedeng mga time deposit, stocks, other marketable securities, trust funds, all of those could qualify as quick ratio since they are already in cash value. Yung iba natin, our inventory and our prepaid expenses cannot be converted back into cash. They have to be converted into a full-blown expense, or they have to be converted into a sales account through the virtue of the business operation. That's why we only consider the cash, accounts receivable, and other forms of cash assets to be our quick assets. So the formula is quick assets divided by current liabilities. So can you identify which accounts in this are the quick assets?
Cash.
Cash.
Receivable.
Okay, we have cash.
Accounts
Okay.
receivable.
Accounts receivable.
Okay, we have cash and we have accounts receivable. So for our current liabilities, it's still the same. Accounts payable and income tax payable. Next, we totaled our quick assets. So 212,000 plus 60,000 is 272,000. And then we total our current liabilities. So 14,844 plus 75 is 14,919. Then we divide the total of the quick assets with the total current liabilities. So 272,000 divided by 14,919 is equal to 18.23 ratio. So we interpret the quick ratio same as we interpret the current ratio. That means with the quick assets that we have, we can pay for our current liabilities 18 times. So interpretation 1 is a good current ratio. It means we have enough to pay for our current debts. Less than 1, that means our cash or our quick assets is insufficient for obligations. So our liquidity is damaged. If it's 1 plus, that means we have a lot of unutilized cash. That means we have a lot of liquidity, and other investors could interpret that as the business not investing enough. So identify the quick assets and current liabilities, and then do the quick ratio.
2.87 po ba, sir? 2.87.
Okay, 2.87.
2.87, sir.
Okay. We'll accept that too. 2.87, 2.86. Malapit naman na. So current asset is 430,000. Current liabilities is 150,000. 430,000 divided by 150,000 is 2.87. Next for this marketing consulting service Inc. Let's first identify the current assets. We have cash and consulting fees receivable. And then we have, for the current liabilities, we have notes payable and income taxes payable.
4.77, sir.
4.77. Okay, other
Ay,
answers?
mali pala, sir. Namali ako.
4.27, sir.
Okay, 4.27. We'll accept that.